Welcome to the Safal Niveshak classroom session on the holy grail of investing and why you, as an investor, must know what it is to make your investing life simple and successful. Let me start with a story dating back to the 1930s. Benjamin Graham, whom we now know as the father of value investing, was an enterprising young analyst on Wall Street in the early 1930s. He made an interesting observation during the heydays just before the Great Depression. He noticed that hot stock pickers, while caught up in the speculative frenzy, would sometimes drive up the stock prices to ridiculous levels in relation to the long-term economic realities of the underlying businesses. On the other hand, these same speculators would sometimes send stock prices spiraling to insane lows that similarly ignored the business's long-term prospects. It was in these insane lows that Graham saw a fantastic opportunity to make money. His reasoning was simple, and that was, if he bought these oversold businesses at prices below their long-term intrinsic value, eventually the market would acknowledge its mistake and revalue them upward. And once they were revalued upward, he could sell them at a profit. This is the basis for what we now know as value investing. Graham was the father of it. So Graham would buy any stock that was oversold and was available at a deep discount to its intrinsic value. He really didn't care about what kind of business he was buying. In his world, every business had a price at which it was a bargain. So when he started practicing value investing back in the 1930s, he was focused on finding companies trading at less than half of what they held in cash. For instance, if a company had $100 of cash per share, Graham would buy it the moment the stock fell below $50 per share. He had other standards as well, such as never paying more than 10 times a company's earnings or a price to earnings of more than 10 times and selling the stock if it was up 50%. Of course, Graham also looked at the financial statements and fundamentals like buying a stock that was available for less than two-thirds of the net current asset value, or companies where the debt equity ratio was less than 1, but his core mantra was buying stocks cheap, and that is where he focused his sights on. Anyways, from Graham, let's move to his brightest student, that is Warren Buffett. Buffett learned value investing under Graham at Columbia University in the 1950s, and then, right before Graham retired, he went to work for him as an analyst. After Graham retired, Buffett returned to his native place, Omaha, where he had time to think over Graham's methodology. During this period, he noticed a few things about his mentor's teachings that he found troubling. The first thing Buffett realized was that not all of Graham's undervalued businesses were revalued upward. In fact, some actually went to bankruptcy. So with every batch of winners also came quite a few losers, which greatly dampened Graham's overall performance. Buffett also discovered that a handful of the companies he and Graham had purchased, which had sold under Graham's 50% rule, continued to prosper year after year. And in the process, he saw these companies' stock prices soar far above where they had been when Graham sold them. This is when Buffett decided that he could improve on the performance of his mentor by learning more about the business economics of these superstar companies. So he started studying the financial statements of these companies from the perspective of what made them such fantastic long-term investments. What Buffett learned was that these great companies all benefited from some kind of competitive advantage that created monopoly-like economics, allowing them either to charge more for their products or to sell more of their products at higher prices. In the process, they made a ton more money than their competitors. Also, Buffett realized that if a company's competitive advantage could be maintained for a long period of time, if the competitive advantage was durable, then the underlying value of the business would continue to increase year after year. And given a continuing increase in the underlying value of the business, it made more sense for Buffett to keep the investment as long as he could. This could give him a greater opportunity to profit from the company's competitive advantage. There was something else that Buffett found even more financially magical. Simply because these businesses had such incredible business economics working in their favor, there was zero chance of them ever going to bankruptcy. This meant that the lower the speculators drove the prices of the shares, the less risk Buffett had of losing his money when he bought in. The lower stock price also meant a greater upside potential for gains. And the longer Buffett held on to these positions, the more time he had to profit from these businesses' great underlying economics. This fact would make him tremendously wealthy once the stock market eventually acknowledged these companies' ongoing good fortune. See how much wealth Buffett has created over these years, and how much has his focus on durable competitive advantage benefited his shareholders. Every US dollar one invested in Berkshire Hathaway in 1964 has turned to $5,133 now, compared to just $66 in S&P 500. So that's a kind of outperformance Buffett has created by using his simple investing strategies. What Buffett found then has now become the holy grail of stock investing, which is the importance of reading financial statements to identify companies with durable competitive advantages. So when you are looking at financial statements, it's important that you look at them not just to read through the numbers and find what looks good and what looks risky, but more importantly, to know whether the company under your observation has some durable competitive advantage or not. Although the words financial statements and accounting send cold shivers down many people's backs, this is the language of business, a language you need to know before buying stocks. The beauty is that you don't need to be a finance expert to understand the basics of the three most fundamental and important financial statements, which are the income statement or the P&L account, the balance sheet, and the statement of cash flows. All three of these statements are found in a firm's annual report. The financial statements are a window into a company's performance and health, and the investor who get richer than others are the ones who know how to look through this window and know how to differentiate a cool breeze from a terrible storm. So pick up the annual report lying untouched in your cupboard, gathering dust, and read whether the stock you are holding is a real gem with a durable competitive advantage or a real dud that will vanish in the next downturn. That's all from me for this time. In the next video, we will discuss the basics of the three financial statements, that is the balance sheet, the profit and loss account, and the cash flow statement. Have a great day. Thank you.